Investors and traders, welcome to the channel. Today is 4th of September 2024. I hope everyone is having a great day. We will be taking a look at the key US markets in this video. As always, this video is for educational purposes only and it's not a financial advice. So we'll start by taking a look at our timing model. This is on the Dow Jones Industrial Cash Index. We had a timing cycle coming in on the 29th of August to 3rd of September. We had actually been forecasting this period months in advance. And in fact, going into this period, particularly last Friday, the market was really strong. With market this strong, I was looking at what the timing could actually bring for us, and it might just have been the holiday effect that the market was that strong. And on Tuesday, which is yesterday, 3rd of September, we saw this really large negative bar coming in. And it also happens to be 3rd of September, which is the kind of window we were watching for, and it was kind of a surprise bar because it just came out of nowhere, in the sense that the market running up last Friday was pretty strong, and then we get a surprise big bear bar, and some of the markets today have actually also closed negative. So we'll start by taking a look at that, and we'll discuss some of the key price levels in the some of these key indices. And now, really important thing to understand is that we have this timing in the Dow Jones, so US markets, and then we also have a key timing coming in the Japanese markets, which I'm going to show you now. Here we go. So in the weekend video, I had actually shown you this cycle as well, which is in the which exists in the Japanese market, and I've also just taken the recent data for it. So for example, going back to October of 2023 for these different cycles operating in here, and we have a key date in the Japanese market coming in on the 5th of September, and then the next one is coming in on the 19th of September. So just make a note of this. So it's going to be really interesting to see the price action, and one of the key things that what I really like to see in my technical analysis, and this is something I've stated before as well, is that the market, or when the price meets the time, the pattern is complete. So we had this timing coming in. We also had the markets, depending on the kind of market we are looking at, NASDAQ around 61.8% retracement, but the S&P 500 was pretty strong. Actually, it was hovering slightly above the 78.6% retracement. So whenever we have price meets time, the pattern is complete, and in my opinion, the news follows the price and price follows the time, and when price meets time, the pattern is complete. Again, just repeating that. So we'll see what the price action will bring for us. So now I'm gonna move over, and actually, before moving over to the bond market, because there is a lot of action that took place in that market, just I want to show you this calendar from forexfactory.com, because we have a lot of action-packed week, which is this current week, and one of the actions that we saw was coming out of this JOLTS report. So you can see the job openings, they seem to be a little bit softer. So what it means is that if the economic data, especially relating to the jobs, is going to be softer, I think the market is not going to like that. Because that might just indicate that Fed might have to do a bigger rate cut, because the market might perceive Fed to be behind the curve. So really important what is coming up tomorrow, which is 5th of September, and the timing that you see here, these are the British summer times, because I'm in the United Kingdom, but for you guys, you'll have to use the time zone, which will be the equivalent of Eastern time zone, so that's going to be New York time. So really key data coming out, which is going to be the ADP non-farm employment change, and then we have the unemployment claims. So you can see all this currency being USD is for the US markets, and the ones which are in red is basically the kind of data which can move the market quite significantly. But anything related to PMI, inflation these days is actually, and also employment is really making the market move quite a lot over the course of several months now. And also we have the non-farm payroll coming out on Friday, so really action-packed week with respect to the economic data. So this is why I think in this week we are going to see quite a lot of price action, and of course we are watching for the key pattern formations and anticipating the key price levels. So let's take a look at the bond markets through the eyes of the treasury notes and bonds. So let's start by taking a look at the shorter end of the curve. So here we go. This is the 2-year treasury note. This is the on the y-axis you see yields, and you can see the yields have been falling. And look at the last couple of days, especially today, 4th of September, a really strong move to the yield to the downside. It actually met our target of 3.9%. We were actually forecasting this level right here back several months ago, April or May. That's when we came up with this black ABCD, and market actually hit that on the 5th of August, which is also a really key date which our modeler also picked up. And now it looks like it's gonna go for a retest of it, and then probably get into this gap formation which I've highlighted between 3.65% and 3.55%. But what is really important is actually to also take a look at the 10-year treasury note yield. So this is the TNX daily chart. This is the yield that we see on the right hand side. Normally we like to take a look at the futures for the treasury note, but I just want to show you something, which is this that the 10-year is now yielding 3.76%. Excuse me. So now if we just go back to, just want to show you something, the 2-year treasury note is yielding now 3.766, but before that it was yielding higher. And what we had was a yield inversion, and what do I mean by that? The 10-year, because it's longer duration, normally should have a higher yield because you are taking more risk because of the duration, because of the time. So that with time there's more uncertainty. So 2-year is closer, of course, in comparison to today than 10 years. And then if you're gonna get the coupons, then there's more uncertainty. Excuse me, vagueness with regards to the reinvestment risk of the coupons. We are dealing with the government debt, so these are risk-free instruments, so the risk of default is pretty much not there, but the concept applies to corporate bonds as well, which will have a default risk. So there are several risk factors involved with longer duration. This is why typically you would want to see in a rising yield curve with the duration higher yields. But we had the inversion. And now the key thing that I want to point out to you guys is that if we take the TNX and then from here we just subtract the 2-year treasury note yield, here we go. So that's going to be the chart of the yield of a 10-year, and from there we just subtract what is the 2-year treasury note, which is the shorter end of the curve yielding for us. So let's see the chart now. Here we go. So that's the key thing. That is really what I wanted to show you, because what was happening before was that it was in the negative territory. So let's actually mark this as it's gonna be a little bit difficult for me to mark. I think that's well, sorry, I used the wrong tool. Here we go. So that's the line where let's say it's 0, so where the yields are equal. Anything below that, the 2-year was actually yielding higher. That's why than the 10-year note. That's why it was in negative territory. But now the yield curve is de-inverting, it's moving back towards its normal shape, and this is really significant. What is likely to happen? It's showing me the date of 5th of September because we have the trading has moved to the next day. So if it moves above, that's a good sign because of the yield curve actually moving towards this more normal shape. But then the other thing is that this you will see the headlines that okay, the recession fears are waning because of the yield curve getting back towards a normal shape. But the reality is that this kind of de-inversion actually takes place a few months or could be duration wise maybe a year and a half at times before the recession actually hits. And one of the things with the recession is we never really find out in real time when the recession started because the data is backward looking. And then the office, which is the statistics office, I'm forgetting the name for it in the United States, they look at the data and then they adjust it and they always come back, oh okay, the recession might have started 3 months ago, 6 months ago, etc. So we never know. But this kind of de-inversion actually takes place a few months to maybe a year before. So we'll pay a really close attention to this one. We will keep on watching this phenomenon as it takes place. So I just wanted to explain this chart and the significance of it. Now, let's take a look at the 10-year Treasury note. This is going to be on the future chart. And there you go. Look at the moves over the course of the last couple of days. Now this one had completed its big ABCD and went into a fairly decent pullback, I would say. But this pullback was nothing more than what the market had done before. So actually, let me get rid of that. I wanted to see this. Here we go. So this is the biggest pullback that we had seen in CD like before, and the market did exactly the same. So this is the market symmetry concept, and it wasn't broken to the downside. That's a good thing because that means that this CD leg has actually a pretty good trend in it and could actually extend so which means that the yields on the 10-year could actually move further lower, and this is clearly probably going to be the case. But there's obvious resistance coming up around 115 in September. From a seasonality perspective for the 10-year, some studies that I have seen, it's not really a great month, so the market could actually go sideways to maybe a little bit lower, but I would expect more sort of a trading range behavior as it approaches this really key structural top around here. So now the possibility of this move happening, I'm going to remove that. But look at this, the strength in this move, and the treasury note market is several times the stock market. So really professional money, big institutional money coming into this market. This just tells you if, for example, we are going to see some economic news coming out tomorrow, Friday, where there's going to be some indication or the perception by the market that the economically things might not be as good. So the data is going to be soft. I think we're going to see more money piling into the treasuries, maybe a flight to quality, for example, and perhaps there could be stress on the stocks as well. So that's what we are looking at in the 10-year treasury note. Now, this is the long bond futures. In the long bond futures, slightly different scenario because this ABCD was never completed. Now the chances are, if it is able to break above this top that came in on the 5th of August, then the CD leg, I personally believe we are still in the CD leg. We are likely to accelerate higher with 128.06. That's going to be the 1.272 expansion of this BC leg, and the other target is going to be around 131. Another key level, which is on the weekly chart, is something possible. I don't know how quickly it could happen, but that's going to be 139.07 because that is the 38.2% retracement of this entire bear move since March of 2020. And if the market begins to move close higher than 139 140 level, maybe that might be an indication that the bear market in bonds might actually be over. And that's where we have the 200 week moving averages hovering around there as well. So the moving averages, which are moving and their averages, and they're always lagging, but they will begin to also, these really longer term averages begin to support that. So that could actually lead to a secular trend higher, or change in trend, in other words. So really interesting what is going on in these markets at the moment. I think we are really at some sort of a turning point for interested markets in particular. Now let's take a look at the US dollar. So this is the daily chart. Now the dollar, we have been bearish the dollar, and this 107 level here has been an important top. In our opinion, this is something which we have discussed several times on the channel, but for the new subscribers, this was a kind of a double bottom formation here because of the structural support. The market bounced, but pretty much this market symmetry concept is there. So every time the market has rallied by this much, it is met with resistance or sellers coming in. And we were just expecting maybe the market could move a little bit higher to 38.2% retracement, which could still happen. So it could be an ABCD corrective move in this overall bearish leg down. And of course the key level will be around this support of 99, which also happened to be 61.8% retracement, easily viewable around on the weekly chart. So ultimately I think that the market will get into this gap around here, and if it breaks, and it's going to be a clean and good break to the downside of 99, which is 61.8% retracement, we could see a sharp acceleration in the US dollar to the downside. Maybe it can come back to about 90, touch this 89, 88 level. That is possibility, but a little bit early, because we cannot really say it will be an A, B, and a C and a D like lower until this 99 level is broken to the downside. And now really longer term, this is some chart that I like to show from time to time, but it's also a beginning of a new month. So let's just visit that. This is on month by month basis, not on quarterly anymore, because I've chosen 1 month here, but 3 months is a little bit easier to pack in a lot of data on the screen. But 1 month is also doing a good job. So here just wanted to show you this concept of market symmetry. So here if we go back to the early 1990s, and the dollar had a fantastic run, and then it actually topped on July of 2001, and there was a secondary peak that approximately took 10 years, and it was right at the 78.6% retracement as well. And then since the secondary peak, which came in around January of 2002, so it's really interesting to see that really big things are happening at the turn of new millennium, or in other words, shorter term, new decade. And then what we saw was dollar just getting weaker and putting in a low around April of 2008, in the throes of the great financial crisis. And then in earnest, it was in 2011 when the bull market in the US dollar started. Now it completed this ABC, this blue pattern around here, and that's where we also have symmetry in the market in terms of equal moves. So that's a red line, and timing wise is approximately 12 years. So there is symmetry in terms of time and price. So that's something really interesting to take a note of. And while it's still possible that the US dollar could actually make another run higher, test these areas, maybe slightly a little bit higher as well. But just the way it had done it right here back in the early 2000s. But if we break this 61.8% retracement to the downside, then the chances of that happening, in my opinion, will become much lower, because that will be a break of the structure and then a much weaker dollar. So we'll just keep on watching this. It's really interesting what is happening, and a weakness in dollar is actually also an indication of lower interest to come. Perhaps this is what the market might be thinking. But the interest rate markets, which are which are not as big as the forex markets, but much bigger than the equities market, but they are also very, very sensitive to interest rate movements, and quite often they are able to sniff or tell a tale way in advance, especially in particular to stocks. That's why sometimes the bond markets are also known as the clever markets. It's just related to interest rates. Okay, so now let's take a quick look on the Euro USD currency. This is the biggest component in the dollar index, and here we can see that nice retracement. As dollar had a retracement to the upside, so I think more likely this is going to resume its uptrend, and we could have a higher target of 1.12. Basically, it is just gonna be testing this gap formation around here, and this break of this is going to be really important, because that way it'll be forming a new trend, a new wave, start of a new wave, and of course making new highs since 18th of July 2023. Now another currency which has been very strong but have had a pretty good sell-off is the Great British Pound. So now it has already taken out the highs of July of 2023, so this is certainly stronger than the Euro USD. So if you are trading these pairs, maybe you can make your selection. And over the course of a week and a half trading weeks, it has gone a little bit lower, quite shallow retracement in my opinion. Let's just see what sort of, not even a 38.2% retracement, so it's just more like a I believe 23.6%. This is something that I'm seeing, especially in certain stocks, that 23.6% retracement getting hit. Although I don't really take a look at that one, this one that much. And here we go. So not even coming to the structural support right here. So really interesting one to watch. And of course, the most interesting one is the Japanese yen. And here we go. So the Japanese yen actually got stronger. In fact, it got stronger over the course of last couple of days, and this is what we have seen. Perhaps one of the reasons related to carry trade that we have seen, certain weakness come into the stocks. Now, really important, if it breaks below this 78.6% retracement, which is around the 143.35 mark on a closing basis, then I think this low of the 5th of August will come into the play. And if it gets broken to the downside, then we are looking at something where the yen is going to be much stronger, and I suspect it'll have something to do with the unwind of the carry trade. So I think the stocks will remain in stress if that were to happen. Now, where it is, there is possible support here, so we can see some bounce off from pretty much from where it is right here, right now, because the 78.6% retracement, structural support from the candle of 26th of August, and then somewhat from 6th of August as well. So an interesting one, very, very interesting one to watch. Gold. So really interesting what is happening in the gold market. So here we go. So the gold, with the dollar being that strong, actually dollar actually being weaker today, gold, which should actually, in my opinion, be much higher, it's just trading sideways. But the good thing is it has had somewhat of a sell-off right from our technical levels of the 1.618 expansion, and right here it found support from the bottom of 3rd of September 2024. So that was yesterday. So I believe it's going to remain a trading range of fear, but the gold is likely to benefit from the US dollar. If the US dollar moves lower, which we think it is going to be doing, then I think it has a chance to move above and test these upper channel formation again. Ultimately, we have this bigger goal of 2700 in gold, and that's where with these big ABCD patterns is completing. But if the market remains strong, it could actually move beyond that to about 3,000. That is possible because of the strong momentum. In fact, gold has been one of the best performing asset class in 2024. But I think over here we could see a pretty good correction coming should we get into the range of about 2,700 on gold. Let's also take a quick look at the silver market, and I'm taking a look at the COMEX gold and COMEX silver. These are not spot markets. So if you're looking at the spot market, your prices will be different, but the patterns are similar. So also right into a support zone, getting very close to about 61.8% retracement. So we'll just keep on watching 61 and 78.6% retracement levels, because that could indicate we might have a B, C, and then a D leg higher. It remains a trading range affair for silver. Silver is of course not as strong as gold. It is also considered as of a base metal. There's much more industrial use for it, but the perception could flip as more of towards more of being an investment or a vehicle. Then we could see some acceleration coming into the silver market as well. Okay, now let's take a look at the markets. So we'll start by taking a look at the S&P 500 cash market. You can see that this market, 3rd of September, a pretty large move lower. It was down by about minus 2.12%. And today we see a candle, but it's not a very convincing candle. I think the price action on futures is something that we should pay more attention to, at least shorter term. And the chances are we could actually move a little bit further right into this gap here, which I've drawn. Let me actually try to shade this. Here we go. This region, and we have the 38.2% retracement just below that. So what I'm thinking overall is that we have the timing come in, of course, but if the markets actually begin to rotate lower, I'm expecting more of a trading range behavior. So the markets could actually pull back a little bit further, 50%. There is one possibility which I'll show you on the futures chart. But I'm expecting the 5th of August low to be held actually. So we might see moves which are more of a retracement, perhaps testing of the 5th of August on extreme levels, maybe going a little bit lower. I'll show you that pattern. But I'm expecting the 5th of August low to be held till the election time. And after that, things could actually change. But this is what I'm thinking most likely is the scenario taking place. Now, let's take a look at the ES. And this is the S&P 500 futures chart. You can see the candle actually closed negative, not on the cash. So cash closing positive is actually a good sign. So there could be a further decline right to the 38.2% retracement. That remains a possibility. Now the possibility that I was discussing was this, that could it be possible we might actually be having this ABCD correction like this, which could see this market come and challenge the 5th of August lows, maybe slightly bit lower, and then just complete its pattern. So I've always kept it, when we discuss it for the first time on the charts. So maybe that might be one thing to actually also look at as one of the possible scenarios. But more of a trading range affair is something I'm more thinking about. So 5th of August lows being a pretty strong low that came in the market. Now, before we take a look at the NASDAQ, let's take a look at the NVIDIA. Here we go. So the NVIDIA earnings came out, and this is what we had discussed. It was sitting right at the pretty good resistance, right at the 78.6% retracement, and then the 1.272 expansion of this. And we were just basically taking a look at two scenarios. At that point, it was just a flip of the coin, which is pretty much the case with earnings, that it could actually move lower, or on the weekly chart there was another pattern formation, but it actually moved close lower after the earnings, and it's just been coming lower. Right here it's finding some sort of support and try to make an attempt for a low right at the 61.8% retracement. Now normally we try to draw the ABCDs when we have a, normally if this candle's high was taken out, so moving into this region of this candle, then we draw the ABCD. There is another way. It is not that I use this too much, but on a lower time frame we could have something of this possibility of an ABCD very close or pretty much at the 61.8% retracement. So it is possible that if we begin to get 2 to 3 consecutive trading days which are positive for Nvidia, then Nvidia might have put in a pretty good sort of a bottom or a low here. And of course it has so much impact on stock indices, NASDAQ in particular, S&P 500, that we could actually begin to see if it begins to move higher, though the selling pressure actually reduce in those, so the market begins to move higher as well. So this is one thing, one of the things I'm watching in the Nvidia stock. And the other one is this right at the 78.6% retracements, about 99 to 100 mark, and then we have this trend line right here as well, so that should be pretty good support. On a break of that challenge of the 5th of August and maybe even the $80 level, I don't think it'll go right to the breakout area around the 21st of February one, but in a really extreme case, this 75 might get challenged, but I don't think that is gonna be the case. Where we are right here, maybe a little bit lower, right, 78.6% retracement. This trend line should be pretty good support. However, if that is broken to the downside, then this ABCD is in play, in my opinion. Now let's take a look at the NASDAQ 100. We'll do that through the eyes of the futures. And you can see that 3rd of September was a pretty big candle, negative candle, and the market was also it has been retracing lower from this retracement level as well, and then it began to close below the 61.8% retracement of right here. So there was an indication. Now this could also be sort of bull flag kind of formation. In my opinion, is a little bit early, and the reason is that because the retracement that we have seen, it's very, very shallow, so there needs to be it's right at the 23.8% retracement. Ideally I would like to see 38.2% retracement and how the market will actually react to that. But we didn't see that. We didn't see that in S&P 500 E-mini futures. We didn't see that in NASDAQ 100 E-mini futures. So in my opinion, the market is weak, and the chances are we are in this ABCD. Well, it's not going to be a perfect ABCD. I would have liked it to be a little bit higher. The candle of 3rd of September. But if we do this, the ABCD also points, I think there was a list low. So that's really interesting where the market actually closed. So let's see what sort of follow through we get tomorrow and Friday, because there's a lot of economic data. The chances are, let's actually, I didn't do the retracement from the 5th of August. There we go. Oh wow, it's 38.2% retracement. So I think where the market is at the moment, it is at a really good support from our levels perspective. Possible ABCD, not really entirely convinced I've drawn it properly, but there is one possibility, one variation of it. I've taken the high of this candle. I would have liked to see some sort of this 3rd of September candle actually going a little bit higher than the 29th August, but this is what I've taken. 38.2% retracement. The only thing is the candle closed negative, so I would actually like to see positive candle close. So therefore we have pretty good support, but the chances still remain the market could actually move lower. So we'll have to wait and see what's gonna happen tomorrow and Friday. Now let's take a look at this through the eyes of QQQ, and there we go. So the QQQ, maybe it has a chance to fill in this little bit of a gap that we had. Here we go, and there we go. So that's another thing, that maybe there is some further pullback that can happen in this. Here we go, and if I draw the 50% is just gonna fill in this gap right here. And if we take XLK, okay, it's already filled that gap. So XLK is actually, it was one of the first ones. Let me show you that on the weekly chart to actually complete the 78.6% retracement. So actually it's just moving a little bit ahead compared to the QQQ. So it's already done that. So that's really interesting to take a note of. So there we go. I think it's going to be really interesting to see QQQs and NASDAQ 100 futures. We are in sort of a support region, but I need further confirmation. So just not entirely convinced on that, but we do have interesting levels for it. Let's take a look at Dow Jones. That's pretty strong, and over the course of the weekend, we had a look at the rotation. From a rotation perspective, the ETF for industrials, and that was pretty strong. So yeah, I mean, look, yeah, sure, it is a double top formation around here, but if we just take a retracement, this index is looks pretty strong. A 38.2% retracement is way below, so that's an interesting one. There we go, 23.6%. So the indices are making really interesting levels. So if there is just not good enough follow through, okay, so I think the market will begin to actually find pretty good support. Now let's take a look at the Russell 2000. And Russell 2000 also had a pullback. Now I can draw a ABCD, which is gonna be an extension. Here we go. So pretty much at the 1.272. Let's see what sort of retracement we got from the 5th of August lows. All right, so this one is also right at the 38.2% retracement. So this is looking really interesting now. The only thing is the candle is negative, so that just tells me there is possibility, at least on the futures, we could see a further downside, maybe to 2128 is possible. So and tomorrow's close, and of course the non-farm payroll coming out, those 2 days are really important. Let's take a look at the IWM, how the price action was on IWM. So I think it has a similar kind of a pattern. Here we go. But this closed positive. So the cash markets are actually at least closing positive compared to the futures, and 38.2% retracement. Fantastic. So I think that's pretty good support level as well. Okay, so I think we might be seeing some bottoming formations taking place, but further validation is needed in my opinion. And let's take a look at the NYA, which is the New York Stock Exchange Composite Index. I believe it has about 2,000 stocks, including ADRs. So it is a reflection of foreign companies in the US. Let's actually move to the weekly chart. This is the one we were looking at. So in my opinion, it has done some retracement, but it's just taken the lows of the previous day's week thus far. But looks pretty strong, and maybe it wants to go to 1.61 in expansion around roughly 20,000. And on the daily chart, there we go. So that is very similar to what we had a look at in the Dow Jones. So thus far, it looks pretty okay. No other pattern that I see, like an ABCD here. So really interesting. I think one of the key things to watch will be the NVIDIA, and if the NVIDIA begins to stabilize in the kind of the price zone that we have identified, that's going to have an overall impact on the key indices, in particular the NASDAQ 100 and also S&P 500. So we'll just keep on watching that, and let's take a look at Apple. Apple is going to have its event pretty soon where they're going to reveal new iPhone 16s, where they have the Apple Intelligence added to them, with the Siri being connected to the Chat GPT. And to get that feature, you have to upgrade your phone, so you have to get iPhone 16. So Apple is, kind of a really interesting one. But from a seasonality perspective, I don't know why this is the case, but Apple seems to do their big releases for softwares and stuff, like especially for iPhones, in the month of September. And September also is a weaker month for Apple. Now, I'm not saying a bearish month, I'm saying a weaker, because the returns for that in that month could be a little bit weaker if you look at over the course of last 1 decade. So I don't know exactly why that exists, but from a price action perspective, what we have seen, Apple, a really strong move of the 5th of August. And then it went right to the 78.6% retracement. It forms a doji, which is basically filling in this gap right here. So this one and this one, and it just shows indecision. And then we have a kind of a follow-through market, but a bearish looking market, and then we had a big drop, and now it's tried to, looks like short covering to me based on this candle. I don't pay too much attention to candlestick patterns, only very few patterns that I really like to take a look at. One of them is of course doji, but any candle where there is gonna be basically a trading range behavior, the buyers and sellers, they fought out throughout the day, is gonna be with a small body, is gonna be a doji for me. Then island reversals, I really like to pay close attention to those. I don't know whether they are really candlestick patterns. And then we have these 3 crows pattern formation that I take a look at. Sometimes hammer pattern. But to be very honest, I think we can get much better signals from bar charts, because that's just the low and high and open and close. But I like to use candles because they're more visual, especially for making the videos. It's easier to see. But I think the bar charts could be actually much more powerful, to be very honest. But here we go. We are using candlesticks here. Let me know what you like. If you think we should use bar charts, then I can switch to bar charts. For me, they're all fine. I don't really take a look at or pay much attention to the candlestick patterns. So that's what we are looking at. Thank you very much for watching the video. I do apologize, the video has been very long, but I think we covered a lot of things, especially with the timing coming in. The market has been pretty volatile, kind of expected because of the timing, with a surprise bear bar coming in 3rd of September. So I think we covered a lot of things. We covered Nvidia, Apple, the stock indices, especially the bond markets, and I will keep you guys posted as things develop in the markets. Thank you very much for watching the video. Good luck, good trading, and speak to you guys soon.